All right, let's jump right into this explainer. Today, we're taking Bank of New York Mellon, better known as BNY, and putting it through the ultimate stock analysis gauntlet. We're going to take their fresh Q1 2026 data and stress test it against history's greatest investment frameworks. We really want to see if this financial giant actually deserves a spot in your portfolio.
Quick look at the roadmap for today. We'll start with a snapshot of BNY, then evaluate it through the lenses of Warren Buffett, Peter Lynch, and Benjamin Graham. After that, we'll hit the pure math with a discounted cash flow valuation, some DDM and comparable models, and finally, bring it all together for a final verdict.
So first things first, let's establish exactly what we're looking at with a quick company snapshot.
Now, BNY isn't your everyday corner street retail bank. They are literally the world's largest custodian. Right now, the stock is trading at $118.63, and honestly, it's riding some serious momentum from a highly anticipated earnings report.
Pulling the foundational numbers straight from that Q1 balance sheet, we're working with an $81.4 billion market cap. They've got a really healthy tangible book value of $57.48 per share. And with a Q1 EPS of $2.24, we can comfortably project an annualized run rate of right around $8.96.
The core story here, it's just sheer, undeniable fundamental strength. We're talking record revenue of $5.4 billion for the quarter, up 13% year over year. That's largely driven by surging fee pools across their securities and wealth services, plus some really robust net interest income. They are absolutely firing on all cylinders right now.
All right, let's move on to our first real test. Let's look at BND through the Warren Buffett lens.
You know the drill with Buffett. He demands a mile-wide economic moat and management that actually cares about shareholders. Well, BNY delivers a fortress-like moat with an almost unfathomable $42.7 trillion in assets under custody. Think about the switching costs for a client trying to leave that ecosystem. They're astronomical. Throw in a massive $10 billion stock buyback program and a 19% dividend hike? Yeah, management is definitely speaking Buffett's language.
Now, to really understand the value here, Buffett would dig into owner earnings, basically the true cash-generating power of the business. Now, calculating exact free cash flow in the banking world is notoriously tricky, right? So as a highly reliable proxy for the capital management can actually deploy, we're going to look directly at their $1.56 billion Q1 net income applicable to common shareholders.
But here's the real kicker, their 29.3% return on tangible common equity. Buffett absolutely loves businesses that generate high returns on the equity they employ, simply because it signals phenomenal capital efficiency. So based strictly on his criteria, BNY is an exceptional business that would likely trigger a buy, as long as the price offers him that necessary margin of safety.
Next up, we're stress testing BNY against two very different legends, Peter Lynch and Benjamin Graham.
Lynch would almost certainly categorize BNY as a stalwart. One of those large, steady growers you rely on to just churn out consistent gains while protecting your downside. Graham, on the other hand, well, he couldn't care less about the narrative. He is ruthlessly measuring the stock price against its tangible accounting value to protect the defensive investor.
So running BNY through Graham's famously strict defensive checklist, it actually passes almost everything with flying colors. Adequate size, earnings stability, dividend record, and a moderate PE ratio around 13.2. Check, check, check. But Graham is a tough grader. It fails his strict price-to-book metric. At 2.06 times book value, it definitely blows past his absolute ceiling of 1.5.
To find Graham's exact theoretical buy price, we've got to use his classic intrinsic value formula. We take his constant of 22.5. Multiply it by that annualized EPS of $8.96, and then by the $57.48 book value per share. Multiply all that and take the square root.
And this just brilliantly illustrates how hardcore the deep value approach really is. That formula spits out a Graham intrinsic value of $107.64. What does that mean? At the current $118 trading price, Graham would absolutely hold off. But Peter Lynch? Well, looking at an estimated 10% earnings growth rate and a 13.2 PE, BNY gives us a PEG ratio of roughly 1.3. For a stalwart, Lynch would likely see this as a solid hold or maybe even a weak buy, especially when you factor in that pristine balance sheet.
Okay, let's leave the gurus behind for a minute and dive into the pure math with a base case discounted cash flow valuation.
Since BNY's quarterly filings obviously don't just hand us multi-year cash flow projections, we have to bridge that gap ourselves.
We're using that $8.96 annualized EPS as our baseline proxy for free cash flow. And for a mature, systemically important bank like this, we'll assume a weighted average cost of capital, our discount rate, of 9%, alongside a highly conservative 2% terminal growth rate into perpetuity.
When we run a sensitivity table on those assumptions, we get a really fantastic grid of possibilities. Our base case, again, that 9% WACC and 2% growth, spits out a fair value of $132 per share. So, pure math strongly indicates that at today's $118 price tag, the market is actually undervaluing BNY's future cash flows.
Let's layer in two more quantitative models, just to be sure: the dividend discount model and some comparable multiples.
Remember, BNY just hiked their dividend to an annualized $2.52 per share. If we assume a reasonably conservative 7% dividend growth rate going forward against our 9% cost of equity, the dividend discount model gives us an intrinsic value of $126. Alternatively, if we keep it simple and just slap a standard 15 times industry PE multiple onto their $8.96 earnings, we land at a comparable value of $134.40.
All right, the final phase. Let's bring all these completely different frameworks together for a synthesis and our final verdict.
Blending all these insights, the picture actually becomes incredibly clear. Only the ultra-conservative Benjamin Graham model prices BNY below its current $118 trading level. Meanwhile, our dividend discount model, our base case DCF, and the comparable multiples all point to an intrinsic value solidly parked in the $126 to $134 range.
Look, the strengths of this business are undeniably powerful. You've got an unmatched custody moat, an aggressive $10 billion capital return program, and soaring capital efficiency. But to be a prudent analyst, you have to accept the risks. BNY's fee pools are super sensitive to broader market downturns, and any falling interest rates could compress their net interest income. But looking at the buy triggers, while Graham is waiting around for $107, the Buffett and Lynch frameworks strongly suggest we are in an accumulation zone right now.
Ultimately, the entire foundation of this analysis, and really the reason almost every model we ran is flashing green, is BNY's incredibly robust, high-quality earnings power. And that's perfectly evidenced by that massive 2.24 Q1 EPS.
So, surviving the gauntlet, BNY looks like a definitive buy for dividend growth and economic moat investors. The qualitative strength and the pure quantitative math align beautifully here. But I want to leave you with this final, critical question. In a market where literally everything feels overpriced, does a roughly 10% margin of safety on a financial fortress meet your personal standard for pulling the trigger? Let that guide your next move.